Hey, this week we get results from a bunch of major industrials. United Technologies, Caterpillar, Stanley Black & Decker, Illinois Toolworks, just to name a few. I'm optimistic about some of these stories, especially United Technologies, but for the most part, Wall Street's expectations are incredibly low. See, the industrials, they've been hammered as investors fret about that worldwide economic slowdown and the trade war. These are all things that are so negative for earnings. But I got an exception, or an exceptional one, though. Last Thursday, we got a terrific beat and raised quarter from a company I don't talk about at all, a company called Dover, all right? It's a classic smokestack stock. It's just exactly the kind of dirty industrial you expect to be really struggling here. Yet Dover caught fire with the stock up 46% for the year. That's extraordinary. So how is it even possible? And more importantly, can it keep climbing? Okay, this company is a manufacturer's manufacturer. Dover gets 40% of its sales from its fluid handling division. Think pumps, compressors, and bearing systems that are used by industrials, oil companies, chemical companies, and gas stations, and even the food and farm industry. They get another 40% of their sales from engineered systems, where Dover makes critical equipment, consumables, and components for all sorts of industries, consumer goods, digital textile printing, vehicle service, environmental solutions, industrial automation, defense, telco, you name it. Finally, the last 20 comes from refrigeration and food equipment, which includes equipment for everything from commercial refrigeration to heating and cooling to food and beverage packaging. It exhausts me to say it all. In short, though, Dover's a textbook example of a smokestack stock. Historically, it's the kind of stock that gets crushed during any kind of economic slowdown, even an international one. Given that this company gets 44% of its sales from overseas, they moved aggressively overseas. That's what it should have done. That's where the growth is supposed to be. It's not exactly immune to worldwide weakness. But in the last few years, Dover's moved aggressively to take control of its own destiny rather than just hope for the strength of the globe. These guys don't want to be just another cyclical enterprise that's totally hostage to the rise and fall of the business cycle. It all started in late 2017, right here. For years, this stock had been obviously an underperformer, held back by its ailing energy business known as Wellsite. They made equipment for the oil and gas industry, so ever since the price of crude peaked in 2014, Dover's energy division became a total dog. In 2016, again in 2017, Wellsite sales were down more than 25% year over year. Every time I would listen to one of the conference calls, I would say, what the hell? Why don't they just get out of that darn business? Well, by September 2017, management had enough. They threw in the towel. They announced a strategic review, and a few months later, they decided to amputate the energy business via a tax-free spin-off. Dover had Wellsite borrow hundreds of millions of dollars to pay their shareholders a big, fat, special dividend, then spun it off as a new company called Apergy in April of last year. At that point, they washed their hands of the whole thing. It was a clean break. Dover retained zero ownership interest. Bon voyage, Apergy. In retrospect, that was a great decision. The price of oil has been stuck in the 50s because every time it starts getting some lift, what happens? Well, you know, our producers bring on more supply and knock it right back down. And that's why the oil service stocks have been such awful performers until perhaps today when Halliburton reported a not hideous number. It was a Naboth. It was not as bad as feared. But Apergy's lost roughly a third of its value since the spin-off. Why did Dover make that call? In part, it's because Third Point, the huge activist hedge fund run by the very smart Dan Loeb, took a position in the company and started to push for it. I think Loeb laid much of the groundwork for this turnaround, although he didn't stick around to see it, but bailing on the stock roughly a year ago, right into the market-wide meltdown. In April of last year, Dover's longtime CEO stepped down. Dover brought in Richard Tobin, then the CEO of CNH Industrial. That's a major British manufacturer, to replace him. And 13 months ago, Tobin rolled out a huge restructuring program. He called it a right-sizing plan to bolster Dover's margins, improve operations, and build a foundation for future growth. Basically, wanted to cut costs and narrow the company's focus, which includes jettisoning a lot of underperforming businesses. In practice, Tobin has trimmed the portfolio, focusing on areas where Dover has proprietary edge and can't easily be replaced by a cheaper alternative, as well as businesses that can give them recurring revenue growth. We love recurring growth. And, man, this guy has delivered. Dover reported a series of strong quarters this year. Execution has been fabulous. Big cost cuts, better management of the company's two core businesses, engineered systems, and fluid handling. However, once we started worrying about a worldwide slowdown, things seemed to get a little dicey. When Dover reported in July, okay, here we go, their sales came in a bit light, even if they still delivered a nice earnings beat. Overall orders were soft. They were down 2% organically. That freaked a lot of people out, although its fluid handling business stayed strong. Still, management said their engineered systems business was hit by a delay in digital printing orders, and they told us to expect better in the second half. They also raised their low end of their full-year earnings forecast. Nah, it wasn't enough. Stock got hit. Only pulling back to $88. Its lows in August as the industrials went out of style with the trade war. China escalated, investors freaked, all that stuff, blah, blah, blah. Fast forward to last month. Dover holds this big investor meeting where they spelled out everything they've done to improve their businesses. Over the past decade, the company's become a smarter, more streamlined business, fewer operating units. They went from 35, who can keep track of that, down to 18. That may still be too many, but much less cyclical and faster organic growth. Management also gave us some ambitious margin expansion targets for their fuelings, solutions, and food retail divisions. Put it all together, and Dover of today is a very different company from the Dover of just even a few years ago. While the stocks shot up back to the triple digits in response to this meeting, it pulled back hard earlier this month. By the time Dover reported last Thursday, it was trading at $95. In other words, the stock wasn't burdened by great expectations. Naboth, right? And if they delivered a good quarter, their share price was bound to go higher, and that's exactly what happened. It posted a 9-cent earnings beat off a $1.51 basis, higher than expected revenues, terrific 6% organic growth. Remember, it was down 2 before. Plus, as promised, the engineered systems business did indeed turn around, up 6%. Give them the benefit of the doubt. Bountiful's Dover's operating margins also increased by 180 basis points. Even better, management once again raised the low end of the full-year forecast. Now they're looking for $5.82 to $5.85 per share. And that's why the stock jumped nearly 6% on Thursday and tacked on another couple of points over the past 2 trading days. Put it all together, and the heavy industrial Dover continues to deliver, even though the macro guys would tell you it shouldn't. Fabulous execution. Worldwide slowdown doesn't seem to be hurting him, and the stock's not too expensive, 16 times earnings. Can it go higher? Yeah, I think it can. Going to the end of the year, I bet money managers will flock into the few industrial names that are actually working, and one of them will be Dover. As I said at the top, the Honeywell pin action extends to a bunch of industrials. Dover's the same way because of the broad range of its businesses it dominates. Company's a quiet, solid manufacturer of boring specialty products, the kind of operation you might never even know about unless you're one of their customers, and that's what's working. Bottom line, Dover has transformed itself into a much less cyclical kind of industrial. That's why it's been able to rally in a tougher macroeconomic environment. It's why I think the stock is more upside going forward. It has reinvented itself by self-help, just the kind of moves we are looking to triumph over a global economic slowdown. Let's go to Michael in my home state of New Jersey. Michael.
Booyah, Jim.
Booyah, Michael.
Listen, China is going to be buying 40 to 50 billion more in agriculture. Should we be buying SMG, some more Scotts Miracle-Gro fertilizer?
Well, actually, the problem with that is that first, we don't know if they're going to buy it. And second, Scotts Miracle-Gro is really more about grass, which used to be what we call cannabis, before cannabis decided it was too, tacky to call it grass. Anyway, Wall Street isn't a fan of the industrials right now, but I've spotted a major exception. Other than Honeywell, it's Dover, and that's because it's transformed itself, and I think it can go even higher. Much more bad money ahead. A NASDAQ for sneakerheads? I'm finding out how one e-commerce site is taking aim at the luxury market, then selling off like it's 1999. I'm digging into whether the derailing we're seeing in the NASDAQ right now is comparable to the meltdown of tech stocks in 1999 to 2000. Here I'm speaking about the cloud-based stocks. How do you handle it? And oil calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.